IDFC Nifty 100 low volatility 30 index fund. Will this NFO add more risk to your portfolio or will it bring more return to your portfolio? Can we analyze? Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. Before we analyze this particular fund NFO, let us understand the key features of this particular NFO. The NFO is open till 23rd September 2022. After that, when the fund gets reopened, you can do regular purchase and repurchase. It is an open-ended equity fund. The category of this fund is an index fund. The benchmark index is Nifty 100 low volatility 30 index. Minimum application amount is just 5,000 rupees. Fund manager is Nimish Sheth. Because it is an equity fund, SEBI's riskometer category is very high risk. What is the investment objective of this fund? It's very simple. It is to provide returns similar to Nifty 100 low volatility 30 index. This fund will simply mimic and replicate Nifty 100 low volatility 30 index. Same set of stocks in the same weightage they will replicate. By replicating that, they will try to give similar returns of the index subject to expense ratio and tracking error. So investment strategy is simple, replicating the index. They will not do any analysis on the underlying stocks in the index. Whatever the stock which is there in the index, in the same proportion, the fund manager will buy. He will try to minimize the tracking error and have as minimum expense ratio as possible. This is being an index fund. If we analyze the underlying index, it will give us better insights. What are the top 10 holdings in this particular index? Nifty 100 low volatility 30 index, top 10 holdings. Nestle India, Britannia Industries, Pidilite, Hindustan Unilever, L&T, SBI Life, ITC, Ultratech Cement, Cipla, Bajaj Auto. All are well-known companies because Nifty 100 is a large cap index, so mostly well-known companies. Out of that, based on low volatility criteria, 30 stocks are shortlisted by the index. So that way, if you look at it, top 10 stocks are well-known companies, large cap companies. And another good news which you can note down is each and every stock has got less than 5% exposure. So that way, stock level concentration seems to be low. There is enough diversification at the stock level. Now let us see the sectoral allocation. FMCG sector has got 25% allocation, IT sector has got 14% allocation, financial services has got 13% allocation. There are other sectors like construction materials, automobile, healthcare, consumer durables, power, oil, gas, consumable fuels, chemicals, construction and all. If you take the top 3 sectors, FMCG, IT, financial services, these 3 sectors amounts to 50%, more than 50% of the overall allocation. So in the 100 rupees, 50 rupees goes to only these 3 sectors. At this sectoral level, there is a huge concentration. Concentration can add more risk. At the same time, concentration can add more return. Whether this index is capable of adding more return or more risk, let us analyze further. This is the past performance of this particular index. Let us take the total return index numbers. In the quarter, so far it has given 11.47% return. In the calendar year, so far it has given you 2.19% return. In the last 1 year, it has given 3.30% return. However, in the last 5 years, CAGR is 13.82% return. So in the long run, this fund has given you a decent return. However, in the short run, the returns are not that great. However, what we have to understand is, being an equity fund, in the short run, they may give low return, they may give negative return, they may not give any return. However, in the long run, they have got potential to give you inflation beating returns. That is what we can conclude from this return chart. Okay, we have understood the key features of this particular NFO. We have also understood the investment strategy. We have also understood how the index has performed in the past. When we did our own research on this particular NFO, we found few positive factors, some important advantages of this NFO that I'm going to list down now. This fund invests in a very diversified portfolio across multiple sectors and multiple companies, which has got long-term growth and minimal volatility, because out of the top 100 stocks in the index, 30 stocks are chosen based on the volatility criteria, low volatility criteria. Being a large cap fund, this fund invests only in companies that generate good amount of economic value. This fund is suitable for ultra conservative investors who are looking for passive investments for their core portfolio. Compared to an actively managed fund, the returns from this fund are relatively stable with less volatility. This fund is free from fund manager bias. In the actively managed fund, the fund manager will pick and choose the best stocks from the index based on analyzing the balance sheet, analyzing the profitability, analyzing the value proposition of the company, capital efficiency of the company, multiple factors. Based on that, the fund manager will do the analysis. Such an analysis is not done here. Here, the fund manager is simply choosing the entire index, all the stocks in the index. Whereas in the actively managed fund, the fund manager does his own calculation, and based on his judgment, he will choose the best stocks. When he does so, there is a possibility his calculation, his judgment can go wrong, and he will end up choosing wrong stocks. This is what known as fund manager bias or stock selection risk. It is not there here because he is buying the entire index. Also, low volatile companies represent relatively stable businesses, strong fundamentals and business models. As it is managed passively, this IDFC Nifty 100 low volatility 30 index fund is expected to have low expense ratio, because here the fund manager is not going to do any in-depth research. So fund management expenses will be very, very minimal. Obviously, the expense ratio will be very low. So far, we are looking at the positive factors of this NFO. When we did our research, there were some negative observations as well. I'm going to list down those negative observations. What are all the disadvantages of investing in this NFO? As this fund invests predominantly in equities, it is not suitable for short-term investments, because in equity, short-term investments can fetch you negative returns. In the short term, the market can be volatile, and this fund has got the potential to give you negative returns also. So because of that, if you have got only short-term money, don't invest in this NFO. This fund may underperform the index due to factors like expense ratio and tracking errors. Being an index fund, this will mimic the index. This fund will not try to outbeat the index. Here, the fund manager will simply replicate the index. Same set of stocks in the index, he will replicate. He will not pick and choose the best stocks like the actively managed funds. The actively managed funds, as the fund manager picks and chooses the best stocks, there is a possibility for the fund manager to outbeat the index. The fund manager will be able to generate additional alpha in the actively managed fund. Here it is not possible. Based on the market outlook, the fund will not be able to change the allocation dynamically from one sector to other sector, or from large cap to mid cap, or mid cap to small cap. This kind of dynamic fund management is not possible here. Here the fund manager has to simply mimic the index. Here the fund manager will not do any analysis on the underlying portfolio. He will not check even the balance sheet of the underlying stocks, profitability. What is the pricing power? What is the competitive edge the company has got? What is the profitability, sustainability of these companies, management quality? None of these will be checked. Simply he will mirror the index. Whereas in the actively managed fund, as the fund manager is checking all these things and chooses a stock, he is actively taking the calculated risk. Whereas investing in the index fund, we are taking blind risk. As an investor, you are supposed to take calculated risk and not blind risk. Taking calculated risk reduces downside risk, increases margin of safety. The major drawback, as you have already seen, tracking error and expense ratio. Because of that, this will deliver slightly lower than the index returns. If you are looking for course corrective actions from the fund manager when the market corrects or when the market crashes, those things are not possible in this particular IDFC Nifty 100 low volatility 30 index fund. Okay, what is the final takeaway? Do I have to invest in this NFO or do I have to avoid? It depends on what kind of investor are you. This fund is suitable only for ultra conservative investors who is not willing to invest in actively managed funds and looking for investments in your core portfolio. There is one more question for which there is no specific clear answer. That is, there are existing Nifty 100 low volatility 30 index fund. It has got a proven track record on having low tracking error and low expense ratio. Whereas here, whether this fund will have low tracking error or low expense ratio is not yet proven. So again, we are taking blind risk here. Actively managed funds has got the potential to deliver higher returns because the fund manager picks and chooses the best stocks. If you are looking for actively managed dynamic fund management strategy and if you are looking to beat the index, then this index fund is not suitable for you. Finally, as an investor, before taking such a decision to invest or avoid this fund, check with your financial planner, because your financial planner knows your financial roadmap. In your financial roadmap to achieve your financial goals, whether this fund is suitable to you or not, he will be able to suggest. Second, the financial planner will be able to do a risk profiling on you and he will be able to come out and tell you, based on your willingness to take risk, based on your appetite to take risk, whether this fund is suitable to you or not. And number three, the financial planner knows your existing portfolio. What are all the existing mutual fund schemes you have got? What kind of portfolio you have got? Based on that, adding this index fund to your portfolio, are you going to add new stocks to your portfolio or is it going to bring just an overlap to your existing portfolio? Whether this overlap or unique diversification is going to help your portfolio or not, that financial planner will be able to tell you. Hope you like this 360-degree analysis on this IDFC Nifty 100 low volatility 30 index fund. If you have any subsequent questions, please comment. We will be able to clarify by giving you an answer. If you have any questions on investments or achieving your financial goals, feel free to book a free appointment with our certified financial planners. To book the free appointment with our certified financial planner, I have given you a link below in the description of this video. Also, we regularly organize insightful investment webinars to educate the investors with investment experts who have 15 to 20 years experience. You can participate in all those webinars for free. Again, I have given you the link below this video to participate in the webinar for free. You can participate in the webinar and get to know the investment strategies and techniques to create wealth, and you can apply it on your portfolio. Hope you like this video. I'll again meet you in yet another useful video. Thank you. Bye-bye.